When the market looks at OR, they see an oil retailer in a world moving towards EV and assumes that the growth is diminishing. But what if that assumption is wrong? Today we argue that OR is a mispriced giant trading below its true earning power. We initiate a buy recommendation based on a target price of 15.52 baht, implying a 15% upside. OR's IPO was overhyped with expectations above intrinsic value. They entered the market during a downturn and their stock price suffered. But this was not a breakdown in their business model, and today's price reflects history, not future cash flows. We believe that there are three hidden drivers reshaping their earnings. First, EV hesitation. Second, aviation resilience. And third, a lifestyle strategic shift. These drivers support our buy recommendation. Let's understand the business. So OR is anchored by its mobility segment with a diverse portfolio that drives recurring traffic that can be monetized through cafes, convenience stores, and other services, allowing them to scale their lifestyle and global segments on top of being an oil retailer. And as of 2024, they generated over 700 billion in revenue, with mobility contributing 90%. And while mobility dominates revenue, lifestyle contributes 1/3 of EBITDA, reflecting a shift towards a higher margin earnings. This combination of oil foundation and margin expansion underpins their earning power. However, let's start off with the market's biggest concern, EVs, and why it is overstated.
Imagine buying a car only to see the price slash by 20% in a month. This is the reality of EV market today. And this led to our first thesis, EV hesitation. We believe the market overestimates the speed of EV transition. As you can see, the price walkout is driven by extreme price volatility and insurance costs. This has triggered asset value anxiety, and now consumers are shifting to reliability. So, we forecast ICE and hybrid vehicles to grow 2.1% CAGR. This shift supports our outlook of gasoline demand, where we forecast to grow 1.09% CAGR. With a dominant market share, OR is positioned to capture this trend among peers. However, we view this as a temporary rather than a permanent reversal of the energy transition. So, what is the real style of the portfolio? Our answer is aviation resilience. Inbound tourism was declined in 2025 and normalizing to 4% growth. The market assumes this will hurt jet fuel sales, but it is a misconception. The aviation fuel is not just driven by flights coming in, but it is also driven by flights going out. So, outbound tourism is the key. The outbound tourism has surged by 45%. So, even if inbound tourism slows, the aviation fuel demand remains strong. We forecast aviation fuel demand to grow 2.73% CAGR. With a massive market share, OR is positioned to capture this trend and unrivaled. Let's translate this strategic key drivers into revenue forecast. Why the volume sold grows steadily? The revenue accelerated to 2.98% CAGR. This is due to high value of the aviation fuels becoming a larger portion of sales, increasing the top line. On the cost side, oil fund has turned to positive due to falling in oil prices. This unlocks higher marketing margin and drives EBITDA margin to 2.3%.
Now, if mobility does the volume, what drives the profit? Lifestyle is a real profit engine. Thailand coffee consumption is rising to 340 cups per year, driven by behavioral shift to premium coffee. Even though BTG is a key player, however, it's come from the pricing strategy which limits their profit margin. So, until BTG can prove they can grow the profit after their recent discount shift, we still remain listed as wait and see. In the past, Cafe Amazon grew through the aggressive mass expansion, but now OR is entering the productivity-driven phase. We expect the batch opening decline to 200 batch in 2026 and 150 batch after that, while the focus shifts into the increasing same-store sales growth at 3.18%. At the same time, convenience store are the traffic magnet. Most PT stations have a convenience store and will turn it into a community hub, targeting to draw 5 million daily visitors. We project the station opening around 80 stations, and each station has a convenience store. So instead of relying on the foot traffic, OR monetize foot traffic to the lifestyle product. And the shift from the grab and go to the premium coffee is already reflected in lifestyle segment revenue, which goes steadily in our forecast. And the structural change in the margin already reflected in the number. As you can see that lifestyle EBITDA margin is around 26% compared with mobility which is only 2%. As a result, lifestyle EBITDA contribution raised to 33% in 2 years, which is a margin inflection point. For CapEx, it's also reallocated to lifestyle, while OR maintain the lowest leverage in the industry. This creates ability to invest without stressing the balance sheet. Moreover, lifestyle segment also improve the cash conversion cycle for OR. So now, OR isn't just a high margin retail, but it's becoming a high margin retail with a recurring cash generating income.
Now, the question in every investor's mind is the broader context and how it will affect OR's performance. While the financial impact is a headline, the real impact is limited, with only just 6% of the total EBITDA. And our valuation is anchored by the ongoing aviation fuel services, the 10-year dealer contracts, and a stable growth from Philippines and Laos. And as management signals no intention to exit the market, we adopt a conservative wait-and-see approach to the global segment. Now, with these three segments and theses, how does it translate into our valuation? Our forecast shows a 2.74% revenue CAGR, as we believe that the company growth is no longer coming from high oil volume alone, but also coming from the higher quality mix of aviation and the lifestyle thesis. Furthermore, we expect the ROE to improve, driven by both margin expansion and higher asset turnover. But the current ROE trend isn't operational. It's a result of low leverage. As the higher margin build up, the equity multiplier decline. So we project ROE to rebound at 11%, signaling OR's operational efficiency. Our valuation using the sum of the parts led to a target price of 15.52 baht and aligned with the DCF and peer multiples, confirming the 15% upside. But this upside doesn't come without risk. We also consider the margin intervention, the decline in departure flights, and the lifestyle competition to quantify the risk impact. Our scenario analysis also shows that the downside is limited. With the bear case of 9% and the bull case that offers a 22% increase of the current price. And given that our valuation using the terminal value, we also stress test the WACC and the terminal growth.
Now, the last question remains: how does sustainability integrated into core value? For OR, ESG is the core of empowering all toward inclusive growth. A high ESG score reflects that commitment for transformation into a living community model. With Net Zero 2050 target, OR green strategies like EV Station Plus, sustainable aviation fuel, and more are clear path toward goal. And we see that it's not just sustainability, it's a hedge against the future trend of EV, along with the turning waste into the value. With social initiative, OR is more than CSR. It's delivered measurable social return on investment back to society. With Thailand, OR generated more than 166 million baht to people. And with governance anchored by Transparency Award, given by the third party, OR can ensure shareholder integrity. Overall, OR ESG is a practice that supports business continuity, improve operation efficiency, along with increased accountability to meet with our target price.
Before we conclude, amidst these challenges, the clearest path to value creation is choosing quality. And OR, with its improving earnings, an environment that empowers all towards inclusive growth, is one of the more compelling investment opportunities, supported by our views in EV hesitation, aviation resilience, and lifestyle strategic shift, leading us to a buy recommendation of 15.52 baht. Thank you.
Okay, I can start with questions. So, in my understanding, the value drivers for the OR appears to be more cyclicality related. So, and first observation from your slides, I've seen a lot of graphs you're using annual numbers, and you're using 2024 actuals and 2025 forecast. First question is, why don't you use actual 25 numbers?
Because since we do this research, we do on October, so we need to estimate the quarter four.
Okay, and did you try to incorporate the Q2 or Q3 numbers into your projections?
Yes, we have take account of the Q1, Q2, and Q3 performance.
Okay.
And to clarify more, we have looked at the actual right now, and you can and the actual or the average field we just different from the actual, just only 1%.
Okay. So another question is the aviation fuel and oil segment appears to be key revenue drivers. And what about the cyclicality of the oil prices now that it's coming down? How do you assess it into your maybe future forecast? If the oil price going down further, will that impair the value proposition that you're proposing today? And also, how do you see OR competition compared to other players like even the lifestyle? I think Amazon, if you look at recent quarterly performances, they're not growing. Even the oil revenue not growing. How are you going to defend that your investment thesis is still valid?
I would be happy to take that question regarding the dropping oil price first. For the appendix, can we go to the oil fund? So I would like to explain the oil fund mechanism in Thailand first. So pretty much the oil fund is made to stabilize prices for end consumers. So when there was, let's say, a crisis and the prices rocket, to keep prices low, the oil fund pays out and subsidizes these oil. As we can see, there's a negative balance, which keeps prices low and it compresses the marketing margins of oil retailers. But as now, since prices are forecasted to drop for oil, there will be this alleviation. So there will be less compression on the marketing margins, which is pretty much the profit per liter that these oil retailers can expect to make. So even if there's less volume, they'll be making more profit per liter. And the second question was regarding their lifestyle, right?
Yeah, sure.
Okay. Because for
Okay, so for the lifestyle, during last year, 2025, Thailand announced that Thai people consume more like specialty coffee, and OR has already recognized that by those guys that you're eating right now is a specialty coffee. So there's already captured the trend of the specialty coffee. So that made me believe that OR can.
may I support my friend's answer? Because we believe they are the best to capture the movement in this trend because of their high penetration rate. Because compared to Pantai, which only has a 30.13% penetration rate as of 2024 in gas stations, we believe that they are, with their scale, they are better positioned to capture this trend. And I think management believes that too, because last year they incorporated their specialty coffee line.
Thank you. Okay, one question for me. Look at the target price that you have, right? Explain one biggest risk that the OR price wouldn't get to that target.
For right now, I will answer it in two ways. For the best risk price impact, it is the oil fund, about the oil coming down. Oil fund coming down, subsidizing the oil fund price and compress the marketing margin. But right now, as the current oil price is coming down, we don't expect the margin intervention from the government. Like as in 1 year that the diesel has been pegged at 30 baht, but right now it has no low probability at the oil price coming up again. And another risk that have high probability, I will go into the aviation and the tourism, because for the tourism, we expect that Thailand is currently having a geopolitical from the border conflict and also the high competition from the neighboring countries like Vietnam and other countries like Japan. With the Thai baht right now also appreciating, it drives the tourism up, and also that we expect the tourism to be the key downside to the
And how long would you think it take to get to that price level? How many months to that price target?
Actually, from the last like 1 to 2 weeks, the price of OR has already
Hit that target.
hit that target, but it is down because.
So if you are the fund managers, would you just sell it already, or you think it will continue?
According to our key catalyst, it is a long-term growth, so it will continue.
You will adjust the target price up. All right, thank you.
Can you talk a little bit more of the risk from the geopolitical issues, the conflict with Cambodia? You you seem to be quite certain that the impact will be small. Could you explain more?
Yes, of course. For the Cambodia, we have already taken the action of the border conflict, and we suggest that it does not tell the investor to worry that much because it's only the 6% of the total EBITDA of the group. And when we see that the other two countries in the global segment, Philippines and Laos, we forecasted a stable revenue growth because we see a growth according to the GDPs that have grown at a 3.32% CAGR. So with the subsidy of the two countries and the compact of Cambodia that we have already penalized by the capex and also the revenue, we forecast that it will only affect a small amount of the price. And also when we look at the global price in the sum of the parts, can we go to this sum of the parts? Yes, this is only the 0.24 baht in the whole total of 15.52 baht. So with this penalization, we take in the effect of the border conflict.
From your first investment thesis on the mobility business, have you researched on the marketing margin and the impact on the price in total?
Yes, we do have research about the marketing margin and how it impacts our price. So if we actually look into this about risks, we put the marketing margin as the most impactful price. So it could be like 0.55% price.
In the past, how's the trend of the marketing margin? And what's
Let me share on this. In the past, we can see that in the past, as you can see that in 2020 to 2024, we can see that the Brent is already spiked, so it squeezed the margin. So it's around, for OR business, is doing a dodo and cocoa. For cocoa business, is company owner average, and dodo is dealer which need to sharing profit to the dealer. However, this squeezed the marketing margin to OR for about 1 baht per liter.
this the trend of the marketing margin is kind of quite in line within the range. How what's the range of what's the normal range of the marketing margin in the past?
For industry, it's about 2 baht, but for OR, because of business model, it's about 1 baht for marketing margin.
And maybe my last question on the WSCC, the discount rate, can you show how you derive the discount rate? How did you sensitize such factor to the valuation?
Okay, so for WSCC, we separate into cost of debt and cost of equity. Cost of equity, we use dominant as a quad guideline. So we use major market equity risk premium from S&P 500 and also the country risk premium of Thailand. And for cost of debt, we use average interest expense divided by interest bearing debt.
Have you compared with the peers and how the peers discount rate looks like?
We do have, and it is average what is, but for OR, since they have no issue on, so for cost of debt, it might lower than peers. Right?